The S&P 500 is a stock market index that tracks the performance of 500 of the largest publicly traded companies in the U.S. It's not just a random collection. Companies are selected based on market cap, liquidity, and industry representation. Think Apple, Microsoft, Amazon, Google, and hundreds more. Together, these companies represent about 80% of the total value of the U.S. stock market. When you hear someone mention that the market went up 10%, people are usually referring to the S&P 500. It's the default yardstick for measuring U.S. stock market performance. The S&P 500 is a market cap-weighted index, meaning the larger a company's market value, the bigger its influence on the index. So when Apple or Microsoft moves 5%, it impacts the index far more than a smaller company like Dollar Tree or Caesars Entertainment. But here's the part most people miss. Not just any large company makes it into the S&P 500. There's a strict set of criteria to qualify. The company must have a market cap of at least $18 billion to be eligible to join the index. It also must be a US-based company and incorporated in the US. At least 50% of its stock must be available to the public, not closely held. The stock must be highly liquid, meaning it's traded frequently with enough volume. The company must have reported positive earnings in the most recent quarter and over the trailing 4 quarters cumulatively. The S&P Committee ensures the index maintains balanced exposure across all sectors of the economy, so sometimes inclusion isn't just about size, it's also about filling a gap in sector exposure. The company must be listed for trading on a major U.S. exchange like the NYSE or NASDAQ. This isn't an automatic process. There's actually a committee, the S&P Index Committee, that meets regularly to evaluate and rebalance the index. This committee is made up of 9 full-time employees of S&P Global. The committee meets monthly to review and potentially revise the index. So even if a company meets the numerical thresholds, it's not guaranteed a spot. The committee also considers stability, risk profile, and the public image of the company within its industry. On the flip side, companies can and do get removed from the S&P 500, and it happens more often than you might think. Some common reasons for removal include falling below the market cap threshold, being acquired or merged, bankruptcy or prolonged financial distress, no longer meeting liquidity or float requirements, headquarters or business shifting outside the U.S. It's a constantly evolving list. Between 20 to 30 companies are typically swapped in and out of the index each year. This is how the index stays relevant and competitive, constantly upgrading to reflect the current leaders of the U.S. economy. Think of it like a team of elite performance athletes. If a player loses their edge, they're benched. If a rising star performs well, they're drafted in. That's part of why the S&P 500 performs so well over time. It's not holding on to losers out of loyalty, it's ruthlessly optimized for performance at scale. Historically, the S&P 500 has returned an average of 10 to 12% annually over the long term. That means $10,000 invested in the index in 1980 would be worth over $1 million today. It has weathered crashes, recessions, wars, pandemics, and still outperformed the majority of investors and competing funds over time. In the last 20 years, over 85% of all actively managed large-cap mutual funds have underperformed the S&P 500. And it's not just professional fund managers. Most individual investors do even worse, often due to trying to time the market, fear-based selling, or chasing market trends. The S&P 500 has a few things that most investors don't. Discipline. It never panics. It never sells in fear. It holds every company, good or bad, until the rules say otherwise. Diversification. It has exposure to all sectors. Tech, healthcare, finance, energy, real estate, consumer goods. It doesn't put all its eggs in one basket. No fees. Unlike hedge funds or other managed portfolios, it doesn't take 2% in fees or 20% of your gains. And most importantly, it's always invested in the winning stocks. Every decade, the winners change. The S&P adapts automatically. You don't have to predict who the next Apple or Nvidia is. It adds them for you when the time is right. Beating the S&P 500 means doing better than the combined power of the 500 biggest companies in America. It means you're smarter than the market, more disciplined, less emotional, and better timed. Statistically, almost no one is. And even when some do beat it, it's often due to luck, not skill. The odds of doing it consistently year after year are slim. That's why the S&P 500 isn't just a benchmark, it's the competition, the gold standard. If beating the S&P 500 is nearly impossible, And just matching it is a smart long-term strategy. Some investors look for ways to enhance their returns by using an income strategy along the way. That's where covered call ETFs come in. These funds track and hold indexes like the S&P 500, but with a twist, they write covered call options to generate monthly cash flow. This strategy will typically underperform in strong bull markets, and overall in the long term due to sacrificing upside in return for consistent income. But during flat or choppy markets, this strategy can outperform thanks to those steady dividends, as well as compounding shares through reinvesting to build monthly income. Popular examples include USCL, a global X fund that follows the S&P 500 with 25% leverage and writes calls on the index. HYLD, a popular ETF from Hamilton ETFs, targeting a 12% yield using their covered call strategy. This one is essentially a concentrated version of the S&P index, which uses 25% leverage. ESPX. This ETF from the folks over at Evolve ETFs targets the S&P 500 index and writes covered calls on 33% of its holdings. Investors who want exposure to the growth of the broader market but also value income and lower volatility often turn to these style of ETFs as a hybrid solution. It's not about beating the S&P 500, it's about riding with it while generating real, spendable income along the way. The index has proven that it offers long-term growth, low fees, diversification, and simplicity. Trying to beat the market may cost you time, money, and sleep. Matching it? That's often the smartest play of all. And with an income play, you can stay invested in some of the biggest and best companies in the world, all while generating consistent monthly dividends to spend or reinvest as you choose. At the end of the day, the S&P 500 isn't just hard to beat, it's designed to be unbeatable. Whether you invest in it for long-term growth or enhance it with income strategies like covered calls, the smartest move is usually to stop trying to outsmart the market and start letting it work for you. If you enjoyed this video, do me a favor and hit that like button and leave a comment if you've ever tried to beat the market before. See you guys in the next one.